Like many of you, I've given much thought to trying to make sense of current stock market behaviors and have many discussions with friends, family, and coworkers around this. So I've put together what follows are my thoughts on trying to make sense of this. First principle to understand here is really important and it's pervasive is that something is worth what people are willing to pay, right? The most expensive house that sold in Toronto last year was worth $23 million in the Bridle Path. You'd ask yourself, is that worth it? But it is because someone paid it. Here we have a Bugatti, $5.4 million for a car. Many of you would ask yourselves, is it worth it? It is because someone's paid for it. The other thing that's important to understand up front is that most of the time, day in, day out, week in, week out, month in, month out, the value of a stock means absolutely nothing to a company. The value of a stock only matters to a company when they want to raise money for their use. For example, if they want to raise $10 million and they currently have 10 million shares outstanding, and the stock price is $10, then they need to sell 1 million shares, which represents 10% of their current outstanding stock. So everybody is diluted by 10% in terms of their ownership. Or if their stock price is $100, not 10, then they only need to sell 100,000 shares to raise that same amount of money. So people are only diluted by 1%. The rest of the time, and this is what almost all of us see all the time, the share price is simply the value assigned for exchanging shares, existing shares between two parties, right? And that has nothing to do with the company itself benefiting from this. It does relate to pride and the value of a stock company for the employees and maybe even impacts their value of their stock options. So if you set aside for a moment the concept that something is worth what someone is willing to pay, the question is, how do you determine what a share price is worth or what is a good share price, right? And you look at the fundamentals historically, right? Earnings per share is the common EPS, which is the current profit of the company divided by the number of shares. So if a company had $10 million in earnings and there was 1 million shares, they're earning $10 per share. So if you had an opportunity to buy a share in that company for $30, would you? If the company continued to operate in this way, that means you've got your money back in 3 years, and anything after that is yours to keep beyond what you invested, right? That's a pretty good scenario. Combine that with if you think the company will even do better, it'll grow faster, it'll has more potential, then you'd be willing to pay even more. That's the concept of the fundamentals of a share price. So having said that, sometimes we see the fundamentals get skewed, often by something called hope. Two very well-known examples of this are Uber and Tesla. Each of these companies we view as incredibly successful companies, but in reality, they're each losing billions of dollars every year. And for that reason, they need to keep selling portions of their company, equity, stock, in order to raise money to have the cash to continue to survive, right? So the question is, given that scenario, why is the stock price so high? And it's because people are betting on the potential of these companies being so much greater than what they have today. Maybe that potential comes from capturing existing markets, right? And when they do that, they can reduce competition, which allows them to raise prices and therefore be more profitable, right? If Uber can put taxis and Lyft out of business, then they can raise prices. Another example maybe is that they enter new markets, right? So maybe the day comes when Uber has driverless vehicles, right? Or they enter commercial transportation, right? Very different markets leveraging the same technologies that they've got. That is the hope that they have more potential than what they have today, right? And these drive growth and they're a big influence on stock price. The logic being that the faster company is growing, the faster their earnings will grow. So if we dive into each of these two companies a little more and we look at something called the price earnings ratio, which is the price divided by the earnings per share. And we look at Tesla, their PE ratio is 1,000, it's over 1,000, which means it takes over 1,000 years for the company at its current earnings level to earn the profits worthy of the stock price that it is today, right? Uber doesn't have one because they don't have profits, right? So the question is, how is that stock worth so much? It goes back to that first principle of something is worth what people are willing to pay. On that principle, one of the big behaviors that we're seeing right now is a large number of individual investors coming into the stock market and trading on a far bigger scale than we've ever seen before. These people are buying in shares of companies that they know and like. They don't, most people, the average person doesn't understand the concepts like fundamentals like earnings per share. they're buying stocks like Facebook, Amazon, Apple, Microsoft, Google, right? And you can see in this chart on the left-hand side, this is the chart. The top bar is the price of the FANG or FAM, FAM, how do you say it, stocks compared to the overall stock market. These stocks are taking off through the roof because people know them, they understand them, they want in on them. And yes, there is some fundamentals because of current economic conditions and everything that says these companies are going to do much better than others and they will be more successful. But I think what we're seeing right now is the average individual investor moving into these stocks, and that's what's changing the stock prices so much. The other major driver of what we're seeing in the stock market is that we are living in an era of extremely low interest rates. People are borrowing to buy housing, right? That's betting that the price of your house will go up more than the cost of your debt, right? People are borrowing money to invest in stocks, betting the return that they're going to make on those stocks will cover and more than cover the cost of your debt, right? At the same time, anybody who has savings, they're looking at what their options are and they're getting close to zero return on other options like their bank account, GICs, corporate bonds. So they don't really have many other alternatives than investing in the stock market. The third major activity that we're seeing at play here is demographics. Baby boomers are reaching their peak savings point. Some have retired, they still have a lot of savings, some are close, but all of this means that they have saved up a lot to fund their retirement. Sometimes that's individually in their personal savings. Sometimes it's the company that they work for has put away money into their company pension plans. Whether it's those individuals or whether it's the pension plans, this money needs to be invested somewhere, right? And what we're seeing is real estate and the stock markets are at historical highs, right? Boomers are also downsizing their homes. That gives them more cash to invest as they get liquidity. Where do they put it? This is why we're also seeing this increased shift to alternative investments, such as private equity, venture capital, diversifying the portfolio. And then those investments in turn are seeing opportunities because of the stock market behavior to take their investments public and do IPOs or initial public offerings, which in turn is fueling and providing even more fuel to the stock market frenzy. The fourth major driver is no secret. Because of COVID, we've seen massive government intervention in all the markets, whether it be corporate subsidies, personal wage enhancement, at a time when there are less things to spend money on, such as vacations, right, which is driving savings, and people are looking to invest those savings, right? We also have this concept of too big to fail left over from 2008, reinforced early in the COVID time period when the government started purchasing corporate bonds in order to protect the companies from failing. And there was even talk that if needed, they would start investing in corporate stocks in order to keep those prices inflated. The last major driver is that the individual investor is now having the time and tools to directly engage in stock trading. Whether they're working from home, they're retired, they're unemployed, they have the time to spend on day trading, and they also now have the tools to do day trading. And those tools are actually coming at extremely low transaction costs. It used to be that if you wanted to buy and sell a share, you had to pay $100 or more each time. Now you're paying pennies depending on the tool you're using. So your transaction cost to buy and sell multiple times through the day is close to zero. When you put all this together, there's two overriding aspects. One is this concept of success fuels success, right? So the more people that are successful, there's people are seeing it, and then they've made more money. They want to reinvest that money and make even more money, right? Combined with FOMO, right? Fear of missing out, right? People are seeing what other people are doing, and they don't want to be left behind, so they're jumping in as well. This is all creating further and further demand. What does all this mean when you put it all together? My conclusion is that in the short term, supply and demand will win, right? People want in, so they're going to pay a higher price than the last person in order to get a share. Supply and demand prevails, right? What we're seeing is small volume trades, such as individual investors, can still have a huge impact on price. All it takes is one buyer to say, I will pay more than the last person, and that as the price goes up. And then you keep repeating that cycle, and that's where you have a GameStop, AMC, Bitcoin, etc. There is no fundamental basis for the value of these companies. They're worth what someone is willing to pay. And I'll touch more on those in a minute. Having said that, in the long term, I think fundamentals will still prevail. At some point, companies are going to want to raise more money to invest in their business. Right now, they're probably doing it through debt because debt is so inexpensive. Interest rates are very low. But when interest rates rise, debt becomes more expensive. So they're going to look to equity or stock, right? When they do that, they're going to need to demonstrate that their stock price is worth it. It's the value is reflective of that. Because at this point, they're talking about raising large amounts of money. They're going to institutional investors, not individual investors. And at that point, they're going to need to go back to fundamentals to demonstrate to those institutional investors that they will get the return on their investment at that stock price, or the stock price needs to come down until that equation works. Now, of course, I need to talk about the current activity being driven by Reddit, right? The reality is the fundamentals of these, I'll call them things, do not support the current values. GameStop is a physical retailer in an increasingly digital market, right? And they're losing millions and millions of dollars every quarter, right? AMC is a large entertainment company that has significant lease commitments in a market that is staying home and going digital. So they're continuing to lose money. And Bitcoin actually has no underlying business. It's simply worth what it is because people are willing to pay, supply and demand, right? Now, the recent activity in Reddit, again, goes back to that supply and demand. People are willing to pay, and they're willing to pay more than the last person simply because they want in, right? So what we have is demand being very widespread, higher than supply. In all these cases, there's no new shares being issued, so supply is fixed. It's limited, if you will, then, right? And as a result, demand is greater than supply, so we're going to see increasing prices. So what happens next? Where are we going from here? Interest rates, in my opinion, are going to be the single biggest factor driving all of this. It's no secret that governments have borrowed trillions of dollars. They need inflation in order to reduce the cost of all of this borrowing, right? They're essentially borrowing this money at the very low interest rates. So if the value of what they've borrowed drops because of inflation, then it effectively starts balancing that out. So higher interest rates will be used to keep inflation balanced, right? None of us, our governments don't want inflation out of control, right? So higher interest rates will then cause companies to shift from debt to equity. And then we talked recently about what happens to that and stock prices, making sure that they're demonstrating value. Higher interest rates are also going to cause people to sell their shares to make sure that they're covering the cost of borrowing, right? And as they sell their shares, demand goes down, prices decrease, and more shares then have to be sold as well. The big question I'm having discussions with all the time is, are we in a bubble? The reality is you only know if you're in a bubble when it pops, right? And you look backwards, right? What I feel reasonably confident is that the value of many stocks and the market overall is not supported by the fundamentals of what companies' prospects are for returning that value. There are many companies that are, and there's many companies that aren't, right? A bubble needs fuel, right? So as long as people are willing and able to pay higher prices to get in, back to the fear of missing out, then stock prices will continue to rise. However, when that fuel runs out, our prices will drop. The real question is, how much will they drop and how soon will they drop?